I want to talk about credit scores. It's really important to understand some of the fundamentals as you go about repairing and rebuilding your credit. Your credit score is such a critical part of your financial health, and it affects just about everything you do, from your ability to borrow money, the interest rates you'll pay, and sometimes even your job prospects. So, if you're new to credit scores or if you're confused about credit scores, because we have so many, don't worry, this video will break down what you need to know in simple terms. Now, for a more comprehensive deep dive into this topic, go over to my Credit Fundamentals community and course. The link is in the description of this video and in the comment section of this video here on YouTube or wherever you're seeing this video. What this video is going to do is summarize the first module of that course. So get into that course while it is still free. So, what is a credit score? A credit score is a number that shows just how trustworthy you are with borrowing money. It typically ranges from 300 to 850. So, the higher the number, the better. This score helps lenders decide if they should lend you money and at what interest rate. Now, there are 5 factors that impact your credit score. Your credit score is based on information that's in your credit report. So, we'll go through the 5 main factors that impact your credit. One, payment history. That is 35% of your score. This is the most important factor. It's going to look at things like whether you've paid your bills on time, late payments, collections, bankruptcies, and more. Anything that can hurt your score a lot. So, as a tip, always pay your bills on time. Set up payment reminders if you have to, or automatic payments. If you miss a payment, pay it as soon as possible. The second factor that affects your credit the most is credit utilization. That is 30% of your score. This is measuring how much credit you're using compared to how much you have available. Ideally, you want to use less than 30% of your available credit. So, as a tip, you want to pay down balances on your credit cards. You really want to keep them below 30%, ideally below 10% utilization. You can ask for a credit limit increase to help with that, and keep unused credit card accounts open. Then there's length of credit history. That's 15% of your score. This is going to look at how long you've had your credit accounts. The longer, the better. So, as a tip, avoid closing old accounts. That credit history is actually helping your credit score. If you're new to credit, you can always start by opening an account and then just using it responsibly. Then there's credit mix, 10% of your score. This refers to the different types of credit you have, like credit cards, car loan, and mortgages. Lenders like to see that you can handle different types of credit responsibly. So, as a tip, if you only have credit cards, you may consider adding like a short-term loan, or perhaps a car loan. One, only take on new credit if you need it, and you can manage it responsibly. Then there's new credit, and that's 10% of your score. This looks at how many accounts you've opened up recently and the number of times you've applied for credit. Opening several new accounts in a short period can lower your score, and lenders typically don't like to see more than, I've heard, two hard inquiries within 5 months. Depends on what you're applying for, but a lot of times lenders have a threshold on the amount of hard inquiries they want to see within a set time period as part of their consideration in lending you money. So, as a tip, limit the number of new accounts that you open. Space out your credit card applications over time. Then there's FICO scores versus Vantage scores. I see a lot of confusion about this. These are the 2 main type of credit scores, and I'm going to give you a simple breakdown. So, FICO scores are the most commonly used by lenders. About 90% of lenders are looking at your FICO scores when they are determining your eligibility. The FICO scores range from 300 to 850. Your FICO score is based on the 5 factors that I mentioned above. Then there's Vantage scores. So when you're looking at Credit Karma, Credit Sesame, Smart Credit Identity IQ, you're looking at Vantage scores. These are newer. They also range from 300 to 850. They use similar factors, but they weigh them differently. So, for example, the Vantage scores may put more emphasis on how recently you have used credit. So why do FICO scores matter more? Well, lenders they use the FICO scores most of the time when they decide if they should lend you money. That's why it's so important to understand your FICO score when you are going through credit repair or getting ready to apply for something. look at and work off of your FICO score. Make sure you're looking at your FICO scores. That's the score you want to focus on improving. So, how do you increase your FICO scores? Well, it takes some time and good habits. Some simple ways to boost your score include paying on time. Make sure you pay all of your bills on time. Set up reminders or automatic payments to help if you have to. Reduce your debt, pay down existing debt, especially the high interest credit card balances. Try to keep your credit utilization below 30%, and as mentioned, ideally below 10%. Keep those old accounts open. Don't close those old credit accounts because they could be helping to lengthen your credit history. And then limit new credit applications. Only apply for new credit when necessary. Multiple new accounts or hard inquiries can temporarily lower your score. And again, as I mentioned, lenders don't like to see a bunch of hard inquiries within a certain period of time. So if you're applying for stuff and you're getting denied, I don't recommend continuing to apply and hoping that you'll get approved somehow, some way with another credit card, for example. Monitor your credit reports regularly, so that way if you find any mistakes, you can dispute them with the credit bureaus. And diversify your credit mix. If you only have one type of credit, consider adding another type, like a personal loan. So how do you rebuild your FICO scores? Well, if your credit score is dropped, don't worry, there are ways to rebuild it. Here's how. One, create a budget. Manage your finances better by setting up a budget. This can help to ensure that you stay on track with your bills, you know what your bills are, and that you get your bills paid on time. Pay off debts. Focus on paying off outstanding debts, especially credit card debt. This will help lower your credit utilization ratio, and that will help to boost your credit score. You can use a secured credit card. So, secured credit cards require a cash deposit, but they can help you rebuild your credit. Check with your bank. A lot of banks have secured credit cards that graduate to unsecured credit cards. You want to use your credit card, whether secured or unsecured, responsibly. Pay the balance in full each month if you have to, and no late payments. Now, you can become an authorized user on maybe a family member or friend's card or account with good credit to add you as an authorized user on their credit card. This can help improve your score without a hard inquiry, but you have to be careful because if they are maxing out their credit cards or if they have a late payment on their credit card, that directly impacts your credit score as well. Credit builder loans. So these are loans designed to help rebuild credit. The loan amount is held in a savings account while you make payments, which are reported to the credit bureaus. And you can check with your banking institutions on that. Avoid applying for new credit until your score improves. I would avoid applying for new credit accounts that are going to cause hard inquiries. So, by understanding and focusing on your FICO scores, you can take control of your credit profile and improve your chances of getting the best financial products and terms available. That's the goal. Regular monitoring and responsible credit behavior are key to maintaining a good credit score and being able to access the best financial opportunities.